Alright family, welcome back. So today we're going to be talking about whole life versus term insurance. Life insurance explained. So I got this idea while watching Marko from Whiteboard Finance explain term insurance and whole life insurance. I just want to put my own spin to it. I really think that it is something that people should look at because it's really strange that everywhere in the world, people buy car insurance, people buy insurance for their homes, but they don't buy insurance for their lives. I know that in this channel we talk mainly about passive income and cryptos, but this is something that I want to add in because I think that everybody should be protected to some point. And I encourage you to stay till the end of this video because I'm going to be going through a cash count in this video, which is a part of a life insurance policy, which actually earns income for you as long as you hold a life insurance policy. But you know what really bugs me the most? Because I'm filming this in the middle of the coronavirus pandemic and we still have people that are going outside without a mask, without a life insurance policy, and then they get coronavirus, and then what happens? They get this huge hospital bill or they die, and who pays for that? Either their family or they just go set up a GoFundMe page asking people to pay for them because they're too irresponsible to set things up, make sure that they're protected in cases like these. There's my angry rant in the first minute of the video. So today's structure of the video, we're going to talk about term insurance or term life insurance, and then we're going to talk about whole life insurance, which is permanent life insurance, and we're going to talk about the details and the pros and cons of each and my thoughts on each. And without further ado, please smash the like button and subscribe button if you haven't already, and let's hop into the video. Alright, so the first thing, term insurance or term life insurance. So there are two really important features. One, it's renewable. That means that you are allowed to renew for another term. And an annual renewal term means that you must renew your term insurance every single year. And every single year, your insurance price will actually get more expensive because you're older. And as you get older, you have more chance of dying. So that's why the price increases every single year for annual renewable term. The second feature is convertible. You're allowed to convert your policy to another cash value policy like permanent life insurance. So I watched the Dave Ramsey video and he argued that you should buy term insurance and then take the rest of the money because term insurance is cheaper than whole life insurance, and then take the rest of the money and invest it into 401ks and Roth IRAs and put them into mutual funds instead of getting a bundled insurance product. If you are a Dave Ramsey fan, fine. I think that some of the stuff he has, like Deb Snowball, that's great, but most of the time or more frequently, I think he's on drugs. Or that could be because he called Bitcoin fake and I am a big crypto, Bitcoin, Ethereum fanatic. So there's that. So here's the thing about 401ks and IRAs. I mean, they're great. I invest in them myself, but to put all your money into those products and have term life, that puts you at risk because what if you get ill? What if you get hit by a car and then you can't work anymore? You need long-term care. Is your 401k or your IRA going to pay for that? No, it's not. But you know what will pay for that? Riders. And I'm not going to get into riders now, but they're basically like term insurance policy that can actually be added onto your insurance policy to make a bundle, which Dave Ramsey is against. So those things can really protect you when you get something like cancer or Alzheimer and you need long-term care because your family's not going to care for you 24/7. So who's going to pay for that care? Your riders. So the average period of time for term insurance is coverage between 20 or 30 years. That's what you look at. And basically, if you or your spouse dies during that time, then the beneficiary gets paid the death benefit, which is, it could be anything. It could be like 500,000 or $1 million, whatever it says in the policy. So now let's talk about the benefits. Really, it's really affordable. It provides the maximum protection for the lowest cost, and it's just really, really affordable. So with term insurance, it matures at death. So that means that you literally just get paid out when you kick the bucket. Otherwise, you're just paying for literal insurance. You're just paying for that chance that you might die without insurance, leaving your family with nothing. It's great for income replacement upon death, and it creates an estate immediately. That means it creates assets immediately. So term insurance is something that you can really use to pay off debt, and it's inexpensive to own. But you're really just letting your spouse pay off debt because you're going to be the one that dies, so they'll be the beneficiary to get the money in order to pay off any debts that you have. You can also use term insurance as a key person policy. That means that you buy a life insurance policy on your business partner. So let's say you are person A and you have person B, that's your business partner. You guys both buy insurances on each other so that if one of you dies, that means that you guys can use the insurance that you bought on them to buy out their share of the company. And for cons, there's only really two cons. The first one is that there's no cash account or cash value, which I'll talk about later in the whole life section. And the second one is that it is costly to renew because every single year, if you bought a 1-year annually renewable term, you're getting older. So every single year, your premium will be going up. So my thoughts on this is that this should be considered temporary. A term life insurance should be considered temporary because the premium goes up every single year. Now the death benefit stays the same, but your premium goes up every single year, which is why I'm saying it should be a temporary thing. Okay, now I want you to write this down. There are two most most important reasons that you should buy term insurance. So write this down. 1. You are starting a family or you already have a family, and because that is the most vulnerable part of your life. Imagine if you have 3 children under the age of 5 and you kick the bucket and you're the main breadwinner. What would your partner do with your income lost because you're dead? So that's what a 20 to 30 year term life insurance policy would protect your family. To be completely real with you guys right now, I was born in a low income family. So my mom didn't work and my dad was a gardener. So we didn't make that much money. He was the main breadwinner because we couldn't afford nannies or we couldn't afford daycare. So my mom stayed home to take care of us. So there was only one income. So it is magical that we made it to adulthood, my brother and I, because we had no life insurance. That means that if my dad, if anything happened to him, if he kicked the bucket, then we would have been done. That would be over, game over for my mom and her 2 kids. So it was by a stroke of luck. I think we were very fortunate actually, such that we were able to make it up to college, that I graduated and my brother's about to graduate without anything bad really happening to us. But we never went on any vacations or anything like that because we're from a low income. And if we did, if anything happened, then it's gonna cost you money because we didn't have any life insurance, we didn't have any critical illness insurance, anything like that. So that was the situation. And I think that's the same for many immigrant families as well. So the second reason is that you are in business with your business partner. So what you should do is buy a key person's policy. That means you buy insurance on each other such that if one of you dies, then the other can use that insurance to buy the other out and take full control of the company. All right, now we're finally on whole life insurance or permanent life insurance. Now, most permanent life insurance matures at age 100, and the premiums that you pay are usually higher because they are needed to fund your death benefit, any operational expenses, the commission fees of the salesperson who sold the policy to you, and your cash account. Now we're going to talk about the cash account in just a minute, but let's talk about how you can pay these premiums. So you can pay the premiums in a lump sum. That means you pay the premiums all at once at one time. Now most people don't have the money to pay this. Or you could do a limited pay. That means you pay up to a certain age, and most people would pay up to age 65 because that's the time they expect to retire. Or they could pay through straight life, which means that you pay until death or until your age 100. And these are all priced differently because you can expect that paying a lump sum you would pay the most money, and then limited pay would be the second most because you have this condensed time span to pay off all those premiums. And then straight life would probably be the cheapest way to pay a whole life policy. So here are the benefits. You get the death benefits and lifetime protection. And you get something called a cash account, which is an account that grows with interest. So basically they take your premium and they put a part of that premium into your insurance, and another part of that premium gets put into this cash account, which is invested in something like the stock market or mutual funds or bonds, treasuries, whatever fits your risk portfolio. So the risk of this cash account is all on the insurer because they have to guarantee you a specified interest rate. And this isn't true for Roth 401ks or Roth IRAs, because if you invest in mutual funds or stocks with your Roth IRAs or your IRAs or 401ks, then they won't guarantee you a specified interest rate. So on a whole life policy, they preach that you can get 1.5 to 2.2% on average of an interest rate, but depending on the product, you can also get 3 to 4%. And the taxing of this cash account is actually pretty cool. So let's say the value of your cash account is more than the total amount of premiums that you pay, then you don't pay taxes. But if your cash account is more than the total amount of premiums you paid, then you only pay taxes on the interest that you gained in the cash account. The hack here is that you don't really pay taxes because you pay taxes when you withdraw the money. So what you do is you actually borrow against that cash account so that you only pay interest on the amount that you borrowed. So when you die, everything will be paid off. But while you're still living, you're just borrowing and paying the interest on what you borrowed. So let's say that your death benefit is $500,000. So the game here is that if you die before age 100, then your beneficiaries get $500,000. But if you die at age 100, that means that your beneficiaries don't get the death benefit. They get your cash value, because at that point, your cash value will be equal to $500,000. So that's the game that we're trying to play. So the game here is that's how it works. If you die before the maturity, age 100, then your beneficiaries get the death benefit, $500K. If you die at age 100, then your beneficiaries don't get the death benefit, but they get $500K anyways because your cash value at that point is $500K. Alright, now let's talk about the cons. The cons are that life insurance policies are issued on a take it or leave it policy. You pay a high premium, and if you give up the policy early, then you usually lose money because a big chunk of that early money is going to the commission fees of the salesperson, operational expenses, and things like that. So let's talk about my thoughts on this. You have to keep this for life, but that makes sense because if you drive a car or you live in a home, then you also buy insurance for your car and your home, right? And that's usually for life. So it makes sense that if you're gonna live, you should probably buy insurance for your life for all your life as well. you get lifetime protection, and you get a cash account that you can borrow against to legally avoid paying taxes on the gains in that cash account. So I'm not even going to say that twice because that's such a hack that if you're hearing it right now, then you got it. And something that I didn't talk about is that you can add riders for long-term care and critical illness to your whole life policy. So let's use an example. Let's say you're 60 years old right now, and let's say you have a friend that's also 60 years old, and you have a whole life policy with a critical illness rider and a long-term care rider. Now, you both are sick. That means that you guys can't go to poop without help wiping your own butt. So in that case, with the long-term care policy, you can hire someone, you can get reimbursed for all that cost, and that doesn't come out of your cash account because your critical illness and long-term care rider takes care of that, or mainly your long-term care rider. But for your friend, your other 60-year-old friend, he doesn't have this policy. He took the Dave Ramsey advice, and he invested his money into 401ks and Roth IRAs, into mutual funds and things like that. So in his case, he doesn't get reimbursed. He has to pull that money from his 401k and his Roth IRA. And when he pulls it, because he's 60, he's old. But in the case of withdrawals, he's still young. He will get penalized for withdrawing that money early. So that's the difference. Fact checked, I make mistakes too. It looks like if you're 55 and older, then you won't get penalized for withdrawing 401k early. But then again, do you want someone else to pay for your illnesses and long-term care, or do you want to pay for it for yourself through your retirement of your 401k and Roth IRA that you spent years building? That's what I thought. Now, since we're at the end of the video, I want to make a quick disclaimer that I am licensed to sell life insurance, but this is all educational, and I'm putting this here because I know that a lot of people would just leave the video without getting the information. So I wanted to make that disclaimer here. Now, I want to make here's the thing about buying permanent life insurance. Now, life insurance agents makes their money through commissions, and some could sell a poorer product with a higher commission to you because they want to make money. It would make sense for the agent to pick the product with the highest commission because they want to make money. So I really advise you to just comparison shop, because there is a lot of different products up there that you can pick, and you want to pick one that provides a superior product for you and that the agent that you're buying from doesn't really care about the commission. They just want to protect you. The best way to avoid being taken advantage of is to get educated like you're doing right now. Or you just leave a comment below and I'll be happy to answer you there, or you can just send me an email and I'll be happy to answer your questions there as well. Other than that, if you learned something from this video, please make sure to like this video, subscribe, and make sure to watch these other videos on passive income investing because that's what we do, or cryptos. Other than that, I'll see you guys again next time.